Hello and welcome to the Rask Network. What you're about to hear and see is limited to general financial information only. Please be sure to speak to your financial planner or refer to our financial services guide available at rask.com.au/FSG before acting on the information.
Welcome back to the Australian Retirement Podcast. Drew Meredith, good morning.
Good morning. A bit less eventful getting here this morning, so I'll happily accept that.
Yeah, welcome.
Or somewhat less eventful.
We're going to jump into asset classes. Just before we do, I've got a little side bet going on how long Drew can sit in this hot studio wearing that jumper. That's a horrible mistake. You're going to be very uncomfortable. Let's see how we go.
It's that weird type of weather in Melbourne, isn't it? Like yesterday it was pouring rain in the morning and then it was beautiful and sunny in the afternoon. So layering, incredibly important on those breezy days, but it's quite a warm studio.
Well, the line bet for me is 21 minutes. So
if you're going to be grilling me,
if you're watching this on YouTube, then just feel free to flick forward to that point and see if we've got there. We've got heaps to get through because today is really dialing into the idea of what do you invest in when you're retired. We've spoken a lot already on this show about how to make sure that your assets are invested in such a way that you can earn enough income and you can perhaps have lower risk within your portfolios. But what we haven't done so far is actually get more granular about the different asset classes that you can invest in retirement or generally invest in. And then also, when would you consider these asset classes and perhaps what are some of the mixes you should have here? Yeah,
and why would a retiree invest into any of them as well? And I think it's incredibly important to do this now as we're still kind of getting started because we know that the spread of financial literacy is huge. As advisors, we generally talk to the audience that is, reading the financial review or like looking at dividend yields or earnings per share, which are probably helping no one out there. But it's more about going back to basics, understanding each of the asset classes, which in a lot of cases, a lot of people we meet with aren't necessarily as aware of some of these asset classes and how they work. And delving into them, but from a very high level from this perspective, with a view to dropping into a bit more detail in future episodes. So going into detail on the type of income, return, historical expectations you should have for each asset class.
Now, I'm looking forward to this in particular because I really get to grill you here. And the reason that I
make me sweat.
I'm going to move that 21 minutes down a bit. But the reason why I can't wait to do that is because this is something that I think you guys do really well. For Wattle, when it comes to investment, you guys have a really well embedded philosophy. You work with a lot of people in that retirement phase. Yep. So I'm going to contribute, but I'm going to lean a bit on you here because I really want to make sure I take as much from this too.
And I'll put some really difficult questions in for you as well. I mean, it's our history as originally one of the first fee-for-service firms in Australia. It attracted a lot of DIY investors. So our business was built around like managing direct share portfolios. One of the first SMAs was built back in the early 2000s and almost too much time and detail into investments. And it still forms a massive part of what we do today. And particularly helping self-funded retirees go from that transition of, we were talking about it before the show, of active income where you're working for a salary to passive income from a portfolio. And as we mentioned, you're very much stronger on the coaching and goal setting that leads up to that phase. And we're very much, a lot of our time goes into the decumulation side. For lack of a better word.
All right, let's jump in. I propose that we'll start with defensive investments.
Yeah, beautiful.
So I'm not necessarily going to say the easiest place to start because there are some intricacies to this, but
it's incredibly complex.
Let's start with cash.
You really want me to swing it?
Let's go.
Yeah, I think the first place, I'll just start initially by saying we're going to look at 6 asset classes. And then sometimes the question is, what's an asset class? And the very simple definition, I had to check this beforehand, is it's a grouping of similar assets. So an asset could be a property, a bank account, a share in a company. It's a grouping of similar assets that have very similar characteristics or react the same way to certain inputs, if that makes sense. So cash is a perfect starting point, a perfect example.
So just to extend on that, of course, we'd have cash, presumably we have fixed interest.
Yes.
We have shares, but we'd split those up, right? To domestic Australian shares and then also international shares.
I think it's important we say Australian, like we say domestic, but that also feels like a financial
Singapore
term.
Listeners out there.
It just feels like we always use these terms where it's Australian and it's international. It's simple, but we always overcomplicate it in finance.
Thanks for calling me out on that. Yeah, fair enough. Yeah, okay,
so we do it. Trust me, our whole system is built on it. It's very difficult to change once it's in there.
So we've got Australian shares or Australian equities, international shares, international equities.
Yep.
We speak to property, presumably.
Yeah, so real assets we kind of group together as property. That's a tangible asset you can touch. And then the last one is alternatives. And we could spend, and we will spend, I think, a whole episode on each asset class. But the purpose of this one is to have a bit of a high level and then look at the why you'd invest in each on the way down, hopefully, in a very succinct way.
Well framed.
Yeah.
Cash. Let's jump straight in.
I took you away from that.
Let's speak a little bit to this. Firstly, what sort of cash investments are available for retirees, and then why should they care?
And for this case, I'm going to put term deposits into the fixed income or the fixed interest asset class. But cash is as simple as the bank account you hold. That could be the bank account in your own name, as well as a bank account in your super fund or your superannuation account. Why would you hold cash? Well, 3 years ago, you probably wouldn't have. Interest rates were zero. And if you wanted any return, people were holding less and less cash. And that's why markets at the time did incredibly well, because they were seeking for returns everywhere else. But today, I think most traditional bank accounts are offering interest in excess of 4%. So immediately you say, I can now get 4% by putting money into a bank account. And the biggest benefit of a bank account or a cash investment at the moment is that you get a government guarantee up to balances of $250,000 per person or per entity, per institution. So essentially you've got a government guaranteed asset that provides a fixed rate of interest that is actually reasonable these days. We won't talk about after inflation or the real interest rate, because that's for another episode. But I think one thing that's less understood about cash, and something we probably work closely with clients on, is it's not just the return that you're getting or the role it plays within the portfolio, but it's the sleep at night factor that comes into it. And do you have a big application of that within your business?
Certainly. Yeah. We don't want to have the need to sell down assets unless we have to. Selling down your assets should ideally be done by choice, and saying timing wise, this is the right decision, or looking at the overall composition of your portfolio, this is an appropriate time, rather than having, for retirees, having a situation where you're just forced to sell whenever the time comes.
Yeah, exactly. And then we have a second one from an investment management portfolio perspective. We have a complex way to say it, but basically when you hold cash within an investment portfolio, it's a call option on the market. So if you've got cash in excess of, say, the 6-12 months of income that you'll need, that you think you'll spend in the worst case scenario, you now have this pool of money that can be deployed or used to buy shares, property, anything that's fallen significantly. Because the last thing you want to do, and we've invested through the GFC, through the COVID, through multiple crises, the last thing you want is to have nothing to invest, to be fully invested when markets inevitably drop, and they always do.
My dad gave me lots of advice, and a lot of financial advice made sense because that was his job too.
He was a financial advisor, I was hoping.
and there was some of it that I heeded and some of it that I didn't. And the advice that I didn't heed but wish I had was I was accumulating wealth in my early 20s and I was investing, and my dad said words to the effect of, you should always have bullets in the chamber.
Yeah.
So if you fire all of your shots, you've got no cash, then if the market tanks, you're just going to be sitting around waiting, just watching the market in free fall, watching your value of your equities plummet and thinking, man, I bought that stock at a 40% premium, 12 months ago. There's a lot to be said for having some bullets in the chamber. And I didn't heed that advice at all. I was as gun-ho as a young person could possibly be.
Of course, right, probably leveraged too.
Yep, right up until the 31st of October 2007. And then that GFC event came, and my net investment value went down significantly. But that happens. I was sort of okay with that, but it was actually really frustrating sitting on the sidelines. It felt like there were all these great deals out there, and I couldn't really participate in any of them. I just had to sit there, and that sucked. So I think that you're speaking to this year.
That's the problem, because if you have an investment that falls 50%, it has to double to get back to where it started. But if you have cash that you can invest when an investment has fallen 50% and it returns, well, you've more than doubled. Or you doubled your money straight away. Not returned to where it was, you've doubled it completely. So that's one of the psychological things we do with clients is that sometimes we have to hide money or hide cash from them. That's probably where this fixed interest next step comes in. So
Just before we go to fixed interest, I'd love to get your thoughts on one thing, please, which is around the idea of the cash rate that you're earning. Now, some listeners might have self-managed superannuation funds. Others might have cash inside, for example, a traditional retail super fund or an industry super fund. There's a big difference between those two, right?
Yeah, exactly. You can go, you can get as low as like 1% from some bank, old-fashioned bank accounts that haven't really evolved. And a lot of people, they call it the loyalty discount, don't they?
Yeah, loyalty premium.
Yeah. And then there's a big cohort of businesses. So some share trading platforms, some investment superannuation platforms, and a lot of them basically make a margin on the cash. So they'll hold cash, or you have to hold cash in a bank account within the platform. They'll be able to invest it at the cash rate, 4.5%, but they'll pay you 2.5%. And that's not just, I'm not going to name any names, but it's a large majority.
Commonplace.
Yeah. And it's a way that they're open about it. It's not hidden. It's just one of the revenue sources that they have to provide the services that they do at a scalable level.
Yeah. And to add to that, if you have a self-managed superannuation fund, for example, I've met a lot of people who are meticulous about their Australian share portfolio and the holdings they have and always looking at this, but then their cash position, like the cash account is in for simplicity, a net bank saver. Yeah. It's in one of those products where,
100%.
Or in a goal saver where it's like, I get 5%. Well, no, you don't. You only get 5% if you deposit $200 every month and you don't make any withdrawals. And anytime you miss those conditions month by month, you're making 1%. So taking a similarly competitive review of your cash to say, well, what return is this actually getting? You'd be surprised how big a difference that can make in your overall portfolio.
Particularly in this environment where you should be getting over 4% wherever you are. And there's ways, good advisors will make sure that you're not holding too much cash in those accounts and aren't paying the full rate of cash. And any investor can do it as well. And I wasn't referring to hiding money from clients. I was referring to finding investments that make it less likely that they want to put it somewhere else. If that makes sense.
I knew what you meant, but I think it was wise that you clarified that point.
Well, there's cash drag, and cash drag was huge when interest rates were zero. And even if it felt the right thing to do to put $100,000 in cash for a client and leaving it in their bank account, they see that every day and they feel uncomfortable with it sitting there, and we've got to spend, we've got to buy, we've got to invest, we've got to we're holding that for either for your cash flow or for something else. It's much easier now that you can get 4% on that cash, and they're more like, oh, we should put more in cash now. But this is where kind of fixed income or fixed interest came in as the next step. And interestingly, there was a Natixis, which is a big global fund manager report, came out a year or two ago now. But they asked individual investors their understanding of how bonds or fixed interest worked, and it was something like 8% of people understood. How a bond, which is a bigger asset class than global shares are, actually works. And that was kind of scared me, and I started writing articles on bonds for quite a few weeks, and they got a bit too detailed as well.
Going to drop some of those in the show notes. Exactly. So thank you very much. All right. Well, can we speak to fixed interest then? I mean, practically speaking, what we're looking at here is an interest rate that is typically fixed, and the funds that you've contributed are going to come back at a specified time, right?
Yeah, I was getting worried we're going to spend the whole thing on cash, so no. I'm going to speed this up. Essentially, when you put cash in a bank account, you're lending that money to the bank, and in return for lending that money to the bank, you're getting an interest rate. When it comes to fixed interest, it's the most basic way to think about fixed interest is investing in a term deposit. You're getting a fixed rate of return, or a guaranteed, in some cases. Guaranteed is a very difficult word for advisors to say, in return for loaning that money to the bank. And the bank usually uses that to some level to support the making of loans on the other side. But you expand that beyond banks, and essentially the government, there'll be a political sideways you can go on this too, but very simply, the government, you're lending money to the government and you're receiving a fixed rate of return. And that keeps going up. So you go from the government to the banks to Woolies, maybe not, it's probably a bad not topical at the moment, but to any level, any number of corporate ASX listed large companies. And then it goes, and that's just called corporate bonds. And then that goes further down into private. So you can lend money to private businesses. You can lend money to property developers. You can lend money to, mortgage, just general mortgages. But basically what you're talking about with fixed income is a loan to another business or a person. And in return, you're getting a guaranteed rate of return, or a contracted rate of return, not a guaranteed rate of return.
And one of the things that a lot of people that do start to dabble in fixed interest or investing in bonds should understand well is that there's no free lunches here. If you're investing in a fixed interest product that promises an 8% rate of return or 8% back after a year or something along those lines, and there's another one that promises 4%, it's very likely that the difference in risks or in risk of each of these products is significantly different.
Yeah.
And as you move up the scale, you think about investing money with the Australian government, that's considered an extremely secure way to invest money. Very, very high likelihood of getting your money back and getting paid on the terms that you wanted. You move to a bank, that's still very, very secure, but not quite as secure.
Yeah.
You move to Woolworths.
A slightly higher interest rate in reflection of that risk.
That's right. The interest rate should match or should be commensurate. That premium should be commensurate to the level of risk that you're taking on. Because with fixed interest, the concern or a focus needs to be not only return on investment, but also return of investment.
So the biggest risk for a fixed interest investment, which is a loan to a company, is that company defaulting and not being able to repay that. And that's where your reward or return comes from. And similar to cash, fixed interest was on the nose for probably 4 or 5 years. You probably like us, you barely touched it when interest rates were zero because you weren't being rewarded for the risk that the company couldn't pay back their money. I mean, they were fine. All the government bonds were offering like 0.3 or 0.4%. So I think that's one of the biggest considerations. And why would you invest in fixed income now? Well, government bonds themselves are yielding at the time a little bit more than 4%, which means corporate yielding, or we always say yield, providing an income of at least 4%. Corporates are going to be higher than that. Private lending is going to be higher than that. So as you can see, you're getting a high rate of interest even compared to the ASX, which currently sits at the time of recording, about 3.8%. So you're getting this contracted rate of interest, and you're also part of the debt side of a balance sheet of a company versus the equity side of the balance sheet of a company.
Now, the last thing I'd like to address as we move through fixed interest is around duration. Because
one of the most difficult to explain and understand topics in.
Let's focus momentarily, if I may, around the idea of how long your money is invested for and what access you have. So if we take a liquidity view, if you put money into a term deposit with the bank at, say, 12 months at today's 5.2% or something along those lines, and then in 6 months or 9 months or 11 months and 29 days, you say, okay, I'd like to get my money, I need it today. You're going to have a combination of either what we call a break fee, which is the bank saying, well, you promised to give us this money over this entire time frame. So because you haven't, you'll need to pay a fee in order to have it released back to you. Or alternatively, you may forego all of your interest, which can be really painful. If you 5%, let's say for simplicity, $100,000, okay, I'm waiting for $5,000 to come back. I'm almost done with my 12-month term, but something's come up and I need the money right now. If you forego that interest, you effectively earn zero for the duration, which can really suck. So knowing how long you should have your money invested for is important. If we move across though to inside a super fund, you want to invest in in bonds, you've got more liquidity because typically you can trade in and out of that when you see fit, right?
Yeah, and I think that'll be another episode where we go into the detail. But one of the benefits of bonds is that they are traded every day. And if things go wrong, bonds tend to perform better than shares do. If something bad happens in the economy, they've got a diversification benefit. But that requires a lot more, probably some slides, some extra show notes.
Yeah, but primarily the concept is that when people are scared of growth assets and when they're not performing well, your shares and property and the like, they've got to put their money somewhere, and they'll naturally look to put money somewhere where it's going to have a higher rate of return. So that's why fixed interest products become quite popular in that environment.
Yeah, exactly.
Yeah. I think the word is counter-cyclical. The term is counter-cyclical, isn't it? Yeah. All right, let's keep moving. Let's go across to shares, please. So why invest in shares?
This is where we switch from the debt side of the balance sheet, so the loans, if you think about it that way, and then the equity side. So if you're comparing it to a person, it's the value of their home in excess of their debt. Investing in shares, basically you're buying the right to the profits and future dividends of a company. Historically, shares or companies more generally have outperformed property. It basically outperformed every other asset class. And there's a reason for that, and that's because companies are they're living beings, essentially. They operate, they grow, they change direction. You look at companies like Apple, Microsoft, which have reinvented themselves multiple times. They're not standing still, as opposed to property. We're not saying negative or positive, but there's depreciating but scarce assets, and then there's assets that are evolving and growing themselves. And why would you invest into them? And this is where we've got a golden rule which I think I've talked about a few times, which is income plus growth equals total return. Income, you can cover a lot from fixed income and cash, but growth has probably been less relevant until recently, where we now know that inflation is real, and inflation does eat up, increase your cost of living and challenge your standard of living. So in our experience, you need to be able to grow that capital as well as generate an income from it to have the maximum probability of your money outlasting you rather than you outlasting your money.
Excellent. Very good. Yeah.
That was my short intro.
If we're going to focus on Australian shares first here. Now, there is a specific reason why the average Australian has such a high proportion of Australian shares.
Home bias?
Yeah.
Oh, we didn't cover this now. Yeah, I think this is what we missed.
If we had someone who was in America or a US investor who said, okay, well, 40% of my retirement assets are in Australian shares.
That'd be
say,
weird.
Well, that's a very strange decision. So why is it that we have such a strong home bias?
Yeah, I think, and we talk a lot about the growth, but Australia has actually been more about income. And there's a very unique, me and Owen have joked about on the Investors podcast quite a bit. I think he's born post franking credits. But there's this little unique thing about Australian shares that in order to avoid double taxation, most dividends where tax has been paid by a company attract or have franking credits attached to them. And those franking credits are basically a credit that is used to reduce your personal tax.
Yeah.
It was actually a big part of quite a few elections in Australia recently too.
Yeah, and may continue to be.
But it's only relevant if you're paying Australian tax. That's why when you say if it was a US investor with a lot of money in Australian shares, they're not getting the benefit of those franking credits.
Yep. Yeah. So without getting too granular, like just to give a simple example of this, you might own
Need a prop.
Yeah, you might own a share in a company that pays dividends, and those dividends are fully franked. So we might say we've got $100,000 for a big number, and it pays a 5% dividend, which means it's paying 5% income, $5,000. If that is a fully franked dividend, what that means is that
we're going to test your maths here.
Already paid tax on that amount.
Yeah.
Right. So if it's therefore the 30% tax has already been paid, and then they've been left with the $5,000 to distribute.
That's from after-tax profits. Yeah.
That's right.
Yeah.
So we'll assume 25% tax rate, or do you want to go to 30?
30 is easy.
Okay. So therefore, we're probably looking at around 68.50 or thereabouts was the actual before tax amount. Then the 30% tax came around, and that eroded it down to 5,000, and then it's been paid out.
Checking those numbers in my head.
We need to calculate it quickly. But so what happens with the franking credits is that when the $5,000 comes to you as income, it has a little note attached to it saying, when you do your tax return, don't forget to point out that this amount has already had tax paid on it.
And they used to actually staple it to the dividend statement.
Is that true? Oh, look, it could have been. I don't know. I wasn't there.
Got to stick with that.
Oh, goodness. I sound an idiot. Well played. And so when you do your tax return at the end of the year, there was two things would happen. Firstly, that $5,000 dividend would no longer be classed as $5,000. It would be increased to take into account that franking credit. So the tax would be paid not on $5,000 but on $68.50.
Yeah.
That's step one. But step two is that when you do your tax return, when it's all the way out the other end and it says, right, you've got to pay tax of, for simplicity, $5,000 this year, that gap between $68.50 and $5,000, so $1,850, that just washes straight off your tax as an offset. And that's hugely beneficial and much more beneficial than having to add that extra bit of income back.
And then if you're not paying tax, or if you're in an SMSF that's in pension phase, so you could have a 0% tax rate, you actually get a refund in cash of those franking credits.
What a time to be alive.
And do not try and take that away from retirees because I think 2 elections have been lost on that single premise, let alone negative gearing.
And there's another implication too, which, as you spoke about at the beginning, one of the reasons we have the home bias is because of that. We have the franking credits. So if you're a retiree and you don't get franking credits anymore inside your tax-free pension, why have the home bias? Why have a higher allocation of Australian equities?
And weirdly, and we think we talk about it slightly differently at Wattle, but weirdly, this franking credit system has set up a bias to the point that a lot of Australian companies pay out much higher portions of their profit as dividends. Mm-hmm. So in Australia, it's not uncommon to have a 75% payout. So 75% of profits are being paid out as dividends, whereas you go to the US, I'm just guessing, but it's more like under 30% of profits being paid out, and a lot more are reinvesting in themselves or buying back their own shares. So it's created like these. It's not necessarily inefficiency. It's just the nature of the market we live in. And what we, as a very simple rule, as we pivot towards global shares, we kind of see, by investing in Australian shares, you're investing into some very traditional and monopolistic sectors. So you're investing into grocery retailers. There's only really two of them of note in Australia, of size in Australia, that own most of the market share. You're investing into 4 banks that literally own like 80%. So, but all very old-fashioned, slow growth businesses, and you're investing into like 4 mining companies. So very cyclical, very specific, and providing you access to what we call kind of old-fashioned or value companies. And then you pivot towards global shares, and that's where we see and look for growth. As a very simple.
So if we're investing in Australian shares then as a retiree, one property that we should be thinking about here is that you're likely to get a higher dividend from Australian shares more broadly than you will if you invest in most international indexes.
Pretty much every asset, yeah.
Yeah, okay. And that's really important for a retiree, right? If you can get, as you said, growth, total return, growth plus income. If you need any of that income, maybe we talked about the defensive part of your portfolio, the cash and the fixed interest. If that's not earning enough income for you to be able to self-fund, dividends can make a big difference to help you along the way.
Yeah, I mean, I think if you looked at the index returns from the ASX over a period of like 15 years, they basically went nowhere. Like it just hit an all-time high, but you got a solid income out of it the entire period. Yep. That's where a lot of the returns from Australian shares have been historically. And the big thing here would be, it doesn't mean you should put all your money into Australian shares because the income's good. And that we do see, I'm sure you do, a lot of people that do that. But as I said, we're very narrow in terms of our investments, and you're investing solely into businesses that are paying out a lot of their profit. You want to invest, if you're going into shares, you want them to both grow and provide income. Because the starting point of this probably should have been, if you've got $1 million and you only need $40,000 in income every year, you can put in a term deposit and you won't eat away the capital. But most people, in our experience, it costs more than $40,000 to live the life that they want. In that case, you need to start thinking about other asset classes and accepting some level of risk to make sure either your capital grows or your income's higher than that 40%. You're not eating away at it every year.
Very good. We're going to move across to global shares. Just before we do, I've got to stick my hand up. It wasn't 68.50. It was 71.50. Apologies. My maths was bad. So let's keep moving.
That was great. I mean, it was a great guess.
I said it with conviction, didn't
5%, yeah. I didn't test it.
All right, so let's kick on global shares. So, I mean, similarly, you're still investing in companies. You're still getting there.
Concept. Yeah.
The concept's the same with some small differences. Why do retirees want to invest in global shares, or to rephrase, for global shares to be part of a retiree's portfolio?
I think the biggest reason is it's only apart from the income and growth you can get from it, Australia's only 2% of the world, probably even less these days. So, and the vast majority of companies we work with, I'm just sitting here, I'm using an Apple, you're using a Samsung. No, is it? Yeah.
It is?
Yeah.
Yep.
They're not Australian companies. Like if you want to diversify your portfolio away from 3 sectors or seek growth, or, be less impacted by events that happen in Australia, then you need to look at investing in overseas companies. And to us, it helps you build resilience into the experience that you have throughout your retirement. So it's more about being able to adjust and not be overly impacted when something significant happens around the world.
Now, just a small point. If you're a cartographer, just to be clear, we're not saying Australia is 2% of the world by size. We are saying that it is 2% by way of its economic contribution.
And that means, by investing overseas, you get exposure to different economies. So you're getting exposure to, you can invest in China, not very topical at the moment. You can invest in the US, also probably not very topical at the moment. But it might not be topical, but it's also where we're doing business with the majority of companies that we work with every day, and also the biggest companies in the world operate in the US. So I think that's one of the biggest challenges people see. And being those larger companies, they've got a greater opportunity to diversify, to grow, and they're operating in much different sectors to which we have access to in Australia, and a very different level of quality as well.
Now, with both Australian shares and international shares, if you're a retiree and you want to go this alone, you've got to be pretty good in order to forge a return that is even comparable to what you can get by just outsourcing this. And this isn't a go to a financial advisor thing. This is just give it to a bloody industry super fund rather than just building your own portfolio, unless you've got a really good basis and want to continue to do it.
I think we'll do another episode that kind of looks at the instruments that you can use to invest in these asset classes. So we're just doing the high level, but we know that you can buy direct shares, you can buy direct bonds, you can use exchange traded funds or ETFs, you can use listed investment companies, and you can use traditional managed funds as well. So this is something, and unit trusts. So we'll consider all those structures because literally every one of them is applicable to every asset class we're talking about. And probably, I mean, you're leaving global shares, and we see that as a source of growth, and thus, a way that you can keep your capital to keep up with inflation, as well as diversify your home bias.
Yep. There's another consideration here, I think, which is that if we look at the long-term performance of Australian shares, 30 years, and we compare that versus international equities, we find that international equities have outperformed
significantly,
and consistently. And there's a number of reasons for that. One of the primary reasons that has come to be is globally the success of tech and the way that tech has driven our share market returns. Australia has a very, very small amount of tech within our share, our ASX 200, just our stock exchanges. And because of that, we don't necessarily get that big uplift. So that's not likely to change in the sense that we're not suddenly going to become this tech haven of the planet. And if we continue to see success in that area, then having all of your shares in Australian shares, because that's what for example, if you're a retiree or a pre-retiree, probably not wise, right?
Yeah, you're missing out. I mean, just in the last 12 months, off the top of my head, like the S&P has done high 20% and the ASX has done teens from memory. So it's like a 10% difference. And you think 10% on a portfolio of $1 million, you're talking about $100,000 in additional value that you can produce. And it hasn't just been that over the last 12 months. It's more like the last 7 to 10 years, as well as even looking well beyond that and 50 years ago as well.
There's a really great slide from Vanguard about this over 30 years with the performance of them. So we'll drop those in the show notes for anyone that wants to see.
Yeah, beautiful. I mean, the next one I'd pivot to if I passed.
As you were.
Yeah, the fourth one. You're talking about very similar to shares, but we're looking at real assets. Mm-hmm. So real assets, most simply defined, is property. Mm-hmm. But in this case, and from an investment perspective, we're looking at property that's more easily investable into as an individual without putting a large amount of capital. So that's more like commercial property. So things like retail, manufacturing, healthcare, offices, but in a diversified way. And in addition to real assets, so anything you can touch, in here trying to grab things, it also expands into things like infrastructure. So buying toll roads, everyone would know Transurban in Australia if they haven't driven on a toll road somewhere. So toll roads, airports, electricity grids, pipelines, but tangible assets that you can see, feel, and offer slightly different benefits and characteristics to shares and bonds.
Mm-hmm. We've got a great podcast that's coming up very shortly on infrastructure with the guys at Magellan. That was really valuable.
Oh, beautiful, yeah.
So I'm sure that will add a lot. Can we speak about, if we talk about property, everyone listening knows what that is, why is it worth considering if you're a retiree, and what are some of the things you need to think about?
And it'd be similar to what you probably discussed in the infrastructure session. Essentially, as a retiree, what we see as most important is resilience and diversification of your income. Diversification of income, there's no better way to diversify it than having some in real assets as well as some in Australian shares. You're literally just buying a completely different part of the market that'll be completely, we'll have some, I could say correlation here, and that's essentially, does property react the same way as shares do to different changes in the economy? And basically you're buying these contracted revenue streams in the form of rental payments. Those rental payments generally increase with CPI, as anyone who has an office or has rented anywhere before, or a rental property. So you're getting consistent income, and you're getting income that's not connected to the income that you're getting from other parts of your portfolio at the most simple. Plus, if you've tried to build a house any time in the last few years, the replacement cost of real assets and infrastructure is significantly high, and a lot of these assets are irreplaceable.
Yep.
And then you can expand on that, and I'm sure you would have gone into heaps of detail on this, which is the benefit of infrastructure versus property is that infrastructure assets are generally the income that you receive is signed off by the government, and the government essentially allows it to grow at a certain rate every year. So you're getting a semi-government, not the G word, supported income stream.
Encouraged.
Yeah, encouraged, supported. I think that was the closest I could say to that word. But again, it's a resilient form of income that will react completely differently to other parts of your portfolio.
Yeah. One of the things that we did cover off on them, again, it's a really valuable podcast, was that concept of it being relatively inflation-proof.
Yeah.
Because if you're invested in a property, for example, and like a residential property, and then interest rates start to ratchet up quickly, well, that immediately erodes your return.
Yeah.
Because if you have debt, then you're now paying a premium on that debt, and that's getting in the way of of the income that you're receiving and the growth that you're receiving. Whereas if you're investing in an infrastructure investment, often those are, like, for example, toll roads. Those costs of that toll road will just go up with CPI and then some.
Guaranteed.
Year in, year out. So you you'll have to edit that one out. But that is really advantageous as a retiree, because certainty of income becomes so important, doesn't it?
Yeah, exactly. And it's government. The government regulated assets. They're monopolistic, as in you have to use most of them, and there's not much competition around them.
Yeah.
But they're government regulated, and you know that the income is going to be supported for same as property. And that's, you don't necessarily get that in a company. If a company does poorly, their dividends aren't going to increase that year. But if these assets continue to act as they do, they're going to be allowed to increase their fees every year.
Let's move down to alternatives.
Yeah, this is the most difficult one. I'm going to cover it in the shortest period we can. I might put this one on you.
Yeah,
Can you define an alternative asset for us?
Well, I can read off the screen. An alternative asset would be one that's it's expected to perform differently to your traditional asset classes. So we've just gone through quite a number of those that we would label as traditional. Alternatives can they might have a different return profile in terms of when money's being paid. They might have a different risk profile in terms of what sort of risks they'll be exposed to if there are market events, and of course there always are. So alternatives don't fit the normal mold of one of these asset classes that we've just spoken about. And a key advantage here is that that concept of diversification, and we're going to be investing in a way that is not necessarily going to behave the same way as the other constituents in your portfolio.
And this is probably one of the areas where I spend the most time talking and educating even clients that, people that are clients of ours, that alternatives are incredibly poorly understood. But if I put it in the most simple way, and it's exactly what you were saying, is you hold alternative assets because you want something that won't fall when the market falls, which means when pandemic happens, when GFC happens, you have something that's going to be worth close to what you invested in. It's not going to fall by 30% like the market does. So you can then sell that and buy the market is in my view the best use of alternatives, which is you can say is similar to cash, but as I said, cash burns a hole in people's pockets. So and then there's if you want to go through briefly, and I think it's probably where we'll close, the types of alternative assets, because they can be incredibly niche, incredibly complex. It can start as simple as currency being an alternative asset, precious metals like gold, bullion, which we've seen as one of the top performing asset classes in the last few years, venture capital, which we've heard a lot about, so startup, early stage businesses, private equity, so just private businesses, not those listed on a share market, private debt, as we said, lending to less, non-listed or less large companies, hedge funds, which scare people, commodity trading, which also scare people, and high frequency trading. But there's actually a spreadsheet that has about 72 different alternative asset classes. You can go as niche as you want, but I think for this context, and you can tell these are all very, very unique and very different, with very different risk profiles to traditional asset classes. Yeah,
this as a house rule, this can be a really valuable area to play in. But I think from what I've observed, I often find that the people that are in this are overweight. They're because once you get familiar with it, you're trying to chase that dragon and catch this huge return. Just you need to be mindful that this can be really valuable as a part of your portfolio, but if you're at a point where you require those massively high returns in order to self-fund your retirement that's dependent on that, you've got much bigger problems and which need to be addressed rather than trying to go all in on alternatives. Yeah, and it's an asset class that's been incredibly popular with industry funds and institutional investors for many decades. And as much as 30 to 40% of some industry funds are invested into alternatives. On average, I'd say advisors are more like 10%.
at the moment, or under 10. You know, it's 8 to 10, but slowly increasing those for the diversification benefits. And I think that's a perfect area to, I think, wrap up this episode. So just briefly, we've tried to do a high level, succinct, long-winded update or summary of each asset class. So that's an asset class with cash in the bank, fixed interest being loans to companies, governments, anyone else, Australian shares, global shares, and we've got our own views on those, real assets, so property, infrastructure, and alternative assets and the role they can play within a portfolio. So once again, I'll thank James O'Reilly for joining me.
Pleasure. How did you take control of this?
I'm not sure.
How did that happen? Well played. You just turned it around on me. A pleasure, mate. Thank you so much for taking us through that. And as we discussed earlier, one of our ambitions is to be going through each one of these in a lot more detail to just equip you as well as possible to be able to make sure that you've got this right in your own portfolio.
And of course, send through any questions you have, investment, non-investment related, and we look forward to answering them.
Thanks, team, and see you again.
Good to see you.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.